Today, we're moving from theory to the real-world execution of trades. Our learning objectives for today are: first, master position sizing and stop-loss logic. Second, create a trade journaling system. Third, understand Indian F&O taxation. And fourth, identify and avoid common trading pitfalls. Our goal is to turn you into a professional trader by focusing on the back-office tasks that actually determine long-term survival: risk management, journaling, and taxes. We will start with the most important rule in trading: risk management. Without it, even the best strategy will eventually lead to a blown account. The first pillar of any trading plan is position sizing. Many beginners ask, how many lots should I buy? But the real question is, how much capital am I willing to lose if I am wrong? The standard rule for professional traders is to risk only 1 to 2% of their total capital on a single trade. If you have a capital of 1 lakh rupees and you decide to risk 1%, your risk amount is 1,000 rupees. To find your position size, take that 1,000 rupees and divide it by your risk per share. If you are trading Nifty with a lot size of 25 and your strategy has a 10-point stop loss, you would calculate 1,000 divided by 250. This means you should trade exactly 4 lots. Notice how the number of lots changes based on your stop loss, not your gut feeling. Now that we know how much to trade, let's talk about where to exit if the trade goes against us. In options trading, stop-loss placement can be handled in 2 ways. The first is underlying based. This means you look at the chart of the Nifty index or the stock itself. If the index breaks a key support level, you exit the option regardless of the option's price. This is often more accurate because the index drives the option premium. The second method is premium-based. Here, you set a fixed percentage or point drop on the option price itself. For example, exiting if the premium drops 20% from your entry. While premium-based is easier to execute on your broker's terminal, it can be tricky because of theta decay and volatility spikes. If the index stays flat but time passes, your premium-based stop-loss might trigger even if the technical setup is still valid. For advanced traders, underlying-based stops are usually preferred. To ensure that your wins outweigh your losses over time, you must respect the risk-to-reward ratio. This is the relationship between the amount you are willing to lose and the amount you aim to gain. We strongly recommend a minimum ratio of 1 to 2. This means for every 1 rupee you risk, you should aim to make at least 2 rupees. Why is this important? Because with a 1 to 2 ratio, you can be wrong 60% of the time and still be profitable. Look at the math. With a 40% win rate at a 1 to 2 ratio, 4 wins bring you 8,000, while 6 losses only cost 6,000. You still end up with a net profit of 2,000. Take a moment to look at this payoff diagram. The goal is to ensure the upside potential significantly dwarfs the downside risk. If you take trades where you risk 10 points to make 10 points, you have to be right almost every single time just to cover your brokerage fees. Next, we move to the most underrated tool in a trader's arsenal: trade journaling. If you don't track your trades, you are simply gambling. A journal is not just a record of profits and losses. It is a map of your psychology and execution. Here are the essential fields to include: date and time, strategy used, entry and exit price, emotion like calm, anxious, or greedy, and mistakes made. You should track the setup you saw. Was it a breakout or a reversal? Most importantly, track your emotions. Did you exit early because you were scared? Did you hold a losing trade because of hope? Here is a simple template you can build in Google Sheets or Notion. Notice the Notes section. This is where you write down if you followed your rules. Over time, your journal will reveal patterns. For example, you might realize you make money on Tuesday mornings but lose it all on Friday afternoons. This data allows you to optimize your trading schedule and strategy. Let's transition to a topic that every trader in India must understand: taxation for futures and options. First, an important disclaimer. The following information is for educational purposes only and does not constitute professional tax, legal, or financial advice. Income tax laws are subject to change. Always consult a qualified chartered accountant for your specific situation. In India, income from F&O trading is not treated as capital gains like long-term stock investing. Instead, it is classified as non-speculative business income. This is actually a benefit for serious traders. Because it is treated as a business, you can deduct all your business-related expenses before calculating your tax. Some of these expenses include brokerage fees and securities transaction tax, internet and phone bills, trading software subscriptions, books and seminar costs, rent and electricity if using a home office, and even depreciation on your laptop or trading computer. By tracking these expenses in your journal, you can significantly reduce your taxable income. Any net loss from F&O can also be carried forward for up to 8 years to offset future business profits, provided you file your return on time. A common point of confusion is when a tax audit becomes mandatory. Under Section 44AB of the Income Tax Act, you may need an audit if your business turnover exceeds the specified limit. Notice the word absolute. In F&O, turnover is not the contract value. It is the sum of your profits and losses. Let's look at an example. If Trade 1 results in a 5,000 rupee profit and Trade 2 results in a 3,000 rupee loss, the turnover is 5,000 plus 3,000, which equals 8,000 rupees. If your turnover exceeds 10 crore rupees, provided 95% of your transactions are digital, which they are in online trading, an audit is required. However, an audit might also be mandatory if you declare income less than a certain percentage of turnover and your total income exceeds the basic exemption limit. Since F&O is business income, you are also liable for advance tax if your estimated tax liability for the year exceeds 10,000 rupees. This is paid in 4 installments throughout the financial year: June, September, December, and March. Failing to pay these can lead to interest penalties under Sections 234 billion and 234.4 billion. Again, keep your CA in the loop to avoid these surprises. To wrap up this module, let's look at the trading graveyard. These are the 5 most common mistakes that wipe out 90% of retail traders. First is revenge trading. This happens after a loss when you try to get back at the market by taking a larger unplanned trade immediately. The market doesn't care about your feelings. It will take the rest of your money just as easily. Second is over-leveraging. Just because your broker allows you to trade 10 lots doesn't mean you should. As we calculated earlier, your position size must be dictated by your risk, not your maximum margin. Third is trading without a stop loss. Many traders say, "I'll exit manually," but when the price crashes, they freeze like a deer in headlights. A hard stop-loss order in the system is your only insurance. Fourth is ignoring theta. Remember that as an option buyer, time is your enemy. If you hold an out-of-the-money option into the weekend, you are paying a time tax. Never ignore the impact of time decay on your premiums. Finally, chasing tips. Social media is full of gurus giving calls. If you enter a trade based on someone else's tip, you won't know when to exit when things go wrong because you don't understand the logic behind the trade. Rely on your own analysis and your own journal. Avoid these 5 pitfalls, and you are already ahead of the majority of participants in the market. We have covered a lot of ground today to prepare you for the practical side of the markets. First, we looked at position sizing, where you should risk only 1 to 2% per trade. Next, for stop loss, always use underlying levels for accuracy. For journaling, make sure to track your emotions and mistakes. When it comes to taxation, treat F&O as a business. And finally, in psychology, avoid revenge trading and tips. You now have the tools to calculate your risk mathematically, track your progress systematically, and handle your tax obligations professionally. Remember, the goal of a trader is not to make 1,000,000 rupees tomorrow, but to be able to trade for the next 30 years. Survival is the highest form of success in this business. Take these concepts and apply them to your next trade. Start small, keep a journal, and respect the risk. Thank you for joining us for this module. We wish you a disciplined and profitable journey ahead in the markets.